up.
Yep, everything's up.
I'll count you down.
Sending data. It's still sending data on YouTube, it says.
Yeah, I see that. I'll count you down when that switches over.
Yeah.
Okay, about 3, 2.
Remember when you were a child and you were waiting for your parents at the doctor's office and there was that one toy where there's a bunch of shapes and there's a hammer and a bunch of shapes to hammer through? Remember you're trying to hammer a square through a circle, a triangle through a star, and it never fixed? That's how it is when it comes to the process of owning a home. People trying to qualify for a different program and then they don't fit. Tonight we are going to go over the 6 main loan programs and find out what fits your needs. What's going on, guys? My name is Min Win with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. And tonight we're going to show you how to simplify the 6 main loan programs. Also, if it's your first time tuning in, do me a huge favor, hit the notification button or subscribe button so you're notified every time we go live or post new content. We go live every Monday night on Facebook and YouTube at 9 p.m. and we post content daily on Instagram and TikTok. Also, this is an interactive channel. So at the end, ask a lot of questions. If you have some questions that concern you about these 6 programs, definitely ask. All right, guys, let's get into the 6 main loan programs. So yes, if you are trying to buy a home, what? What'd you say?
Keep going.
Okay. Sorry about that. That was my director. So if there is a loan program you're trying to qualify for out there, there's probably going to be one of these 6 programs. If you want to know how to qualify for all the programs, there is a guide we have called the Ultimate Mortgage Guide. You can go to whatsamortgage.com and download our Ultimate Mortgage Guide. If you download this guide, it will give you the foundations to qualify for any loan program. Even if we don't have the loan program on today's live, if it's out there, these guidelines will help you qualify for any program. The only guideline, the only program out there that doesn't fit the box, stuck on, is the video stuck for anyone? The video stuck for Fred.
Tell them to refresh their browser.
Refresh your browser, Fred. So if you're trying to qualify for any program, it's probably going to fit on these one of these 6 programs. Actually, one of the programs, I take that back. One of the 5 won't fix, which is our non-qualified mortgage, which has become very popular. And we're going to go over how non-qualified mortgage works. So let's go over our 6 main programs. So if you are trying to qualify for a residential mortgage, which means it's a home between a single family home, a condo, a duplex, a triplex, or a fourplex, or a manufactured home, typically you're going to qualify with one of these 6 programs. Lucy said it's stuck too. Yes, it's stuck. I can still hear it. 1 second here. Monitor's okay. Sorry about that, Lucy. It seems like it's okay here on our side. Just hit refresh. So let's get into first our USDA program. So it's a very popular program. It's backed by the government. It's 0% down. You don't have to be a first-time home buyer, right? There is an income limit though. When you're trying to qualify for this USDA program, it's for rural area. There is an income limit. Anyone over 18 years old who is going to be living in the property, their income is counted towards qualifying, towards the income limit. Of course, you can go to the USDA website and find out what is the qualifying income limit. So when you're doing the loan application and they find out who your dependents are and how old they are, if there is a dependent over 18 and they are currently working, that income is counted towards your income limit. Okay. Another thing with USDA, which differs from other programs, there is the USDA commitment review, right? VA loan, FHA, conventional. With these programs, once the underwriter clears it for docs at the bank, you're good to go. With USDA, there is a commitment review that has to go out to USDA for them to clear. You can Google USDA commitment review and put the name of the state, and you can see how long each state is taking. Okay, it's really important that you know these things when you want to go USDA. You just can't pick a property. Ooh, I want 100% financing. It has to be in a rural area. On the USDA website, you can put in the address. It will tell you if it does pass and it meets the USDA guidelines. Okay, remember it's 0% down. Remember, when you're buying with a USDA, it's for owner occupied only. So you can't buy some rural land and you're not occupying it. It has to be owner occupied. And the guidelines of credit, what it does, it fits other automated or non-automated. So you want to be in a 640 credit score up to qualify under their automated underwrite, which is their GUS program. And typically the max debt to income ratio for the automations is 33/45. USDA has a little bit stricter debt to income ratio than other programs, especially when it comes to government loans. We'll talk about next in FHA and VA. They're a lot more aggressive when it comes to the DTI. With USDA, that's the one thing that makes them different compared to other two programs. They're not that aggressive when it comes to debt to income ratio. Okay, if you're under 640 credit score, now you have to go to a manual underwrite, which is 29/41. Okay, also the property cannot be income producing. Okay, even though you bought a land, it's rural, there's farmland, there's animals on there, or it does make money, you cannot use any of that income to qualify. First of all, it should be making money, but if it is, you can't use any of that income. Okay, if you want to see if that property falls under rule, you can take the address of the property, upload it on the USDA website, and it will tell you yes or no. Okay, here is the best thing about USDA. If you write the purchase contract, let's say for 400, and the value comes in at 408, 410, you can use the difference of the value to cover your closing costs, which you can't do with any other loan program, right? Like I said, listen to me here. If you write an offer, let's say, so if you know you're writing an offer on a USDA purchase, if you go under what the appraised value is, if it appraises above, you can use the difference to cover your closing costs. That's insane. Okay, so that's really important when it comes to trying to buy a USDA 100% financing. It is, I say, one of the true 100% financing, right? You can take a higher rate, also help you with closing costs, but now you can use the value if the home over appraises. All right. The secret about their site, the secret about USDA is you got to go on their site. You got to go on their site and check the income, check the value, right? Check the commitment. How long is it taking? So when you do buy a home and it's USDA, there are perks, but you have to go through a lot of procedures just to make sure the property qualifies and you qualify to buy the house, right? Low DTI, but it's a great product out there for anyone who's buying in a rural area. All right. Let's look at our VA. Right, the second best program, right? Second best program, of course, VA. I think it's number one because there's no monthly MI. With the VA, with the USDA, there is monthly MI, but I think it's second best because not everyone is going to be a veteran. But if you are a veteran, it's 100% financing, no monthly mortgage insurance, right? Low interest rates. The rates are lower than FHA, right? Typically, FHA has the lowest rates, right? FHA and USDA have very similar rates, but VA has even lower rates, right? The perks about VA, very popular, right? The renovation loans. Renovation loan is big on VAs, right? Because if you have any disability and you buy the property and you need to do some renovations, VA really pushes to help with renovations so the house is accessible for disabled people, right? Also, I love about VA, for all you veterans out there, you can reuse your entitlement. What does that mean? If you buy a home with a VA loan, right? Typically, some veterans like, I want to do some house hacking. You buy a home with a VA loan. You run out your entitlement. You try to buy your another home. You can still go VA, but you might not get 100% financing. But if you take your VA loan and you refinance it out to a conventional or out to an FHA, right? I think mostly conventional, that's what a lot of people do, right? Their entitlement is restored and they can buy VA again. So a lot of veterans use the VA loan to house hack, but they got to time the equity, right? So they have enough to refinance to a conventional loan so they can buy VA again. A lot of times when you do it too soon, you might have monthly MI, but it still might be worth it. You might not want to wait forever till you have 20% equity to go from VA to conventional. A lot of veterans I see wait till they have 10% equity, where the PMI is cheaper on a conventional. They'll refinance to conventional, reuse their entitlement again, and keep buying, right? So I think that is I think probably one of the best things about VA loans, right? Which a lot of veterans don't take advantage of. Also, when you do these VA house hacks, make sure you're always upgrading and not downsizing, right? What do I mean by that? let's say you buy a home with a VA loan. I would start first with a 4-unit. Then I would downsize to two big 2 units or 3 units, and then a duplex, right? And then maybe a smaller condo, and then a small single family home and a bigger single family home, right? But every time you would go from a 4-unit, refinance it to a conventional loan, buy a 3-unit, refinance it to a conventional loan, buy a duplex. As long as it looks like you went from a smaller place to a little bit bigger, right? Or people who go from 4 units, typically they'll go from 4 units to 3 units to 2 units. No one goes from a duplex to a triplex to a fourplex, right? Unless it's some insanely nice fourplex from a duplex and it's bigger, right? Which is pretty rare when you start going from duplex to fourplex when it comes to the size of the bedrooms, all right? So make sure when you go VA and you house hack, you pay attention to making sure you're upgrading and not downsizing. I see a lot of people who house hack and they went all in on their first house, and their second house, why couldn't I go VA again? Why didn't they believe me? I refinanced into conventional loan. They want to make sure it makes sense. And also with veterans, with VA, you fall under the standard guidelines. 90 days during wartime, 181 days during peacetime, and 6 years in the reserves and the Coast Guard. And also when you are buying with VA loan, right? If you are in a community state, you got to run the spouse's credit. And only the spouse, though, can help you co-sign to buy a home with a VA loan unless the other person who's buying with you is also a veteran and has their veteran benefits. Outside of that, you can't use your brother, your sister, your mom, your dad, your cousin. It must be a spouse or someone else who has VA benefits as well, okay? The cool thing about VA, 580 FICO score and up. You can go under 580, but not a lot of lenders are doing under 580s right now. I'm not saying that there isn't any, but it's really hard to find. So if you want to make sure you have a high chance of qualifying and a road of less resistance, you want to go with a 580 credit score. And the properties that are eligible: single family homes, condos, townhouses, duplex, triplex, fourplex, and manufactured home. Okay. Here's the tricky thing about VA. You can always refinance your VA loan with into an investment VA loan. You can't buy a home with you can't buy an investment property with a VA loan, but like I said, if you have multiple VA loans, you can refinance your investment as a VA investment loan, but you just can't buy VA investment. That's kind of the quirky thing about it. So if you are qualified to buy with a VA loan, I highly do recommend it over conventional. A lot of people do weigh in, well, because of the VA funding fee. But of course, if you have the 10% disability or the Purple Heart, it doesn't matter, right? The funding fee is waived. But pound for pound, a VA loan will trump a conventional loan all day long. Rates are lower, no monthly MI, right? So it allows you, and it's more flexible with credit. You can go down to 580. We do recommend that 620 credit score. The reason why I recommend 620, you're going to get a better deal. When you start hitting that 640, 660, you're going to be able to get closing costs covered, right? Unlike USDA, if it appraises more, you cannot use that amount of money to cover your closing costs. You'd either have to come out of pocket or take a higher rate. And it's hard to do so if your FICO score is not above that 620, 640 threshold, right? Once you're above 620, 640, you're able to get some closing costs to help you cover it. I'll answer that question in a second, Alan. All right, so that right there is our second popular loan program, okay? Let's talk about the third one, FHA loans, okay? Are we on FHA loan or conventional? FHA loans, right? FHA loans. Let's go over to our FHA loans right here. So FHA loans, they're backed by the government. They have monthly PMI that is permanent unless you put 10% down. If you are buying with 10% down or more on a FHA loan, which I see people do because of their BKs, right? It's kind of weird. It's like you have a bankruptcy that you said you cannot pay the bills, but you can buy FHA and put 10% down, which I see people do, right? I don't know how they're doing it or how they're getting away with it. I'm not, like I said, I'm not here to judge, but typically when you file bankruptcy, you tell your debtors you can't pay them off. But for some reason, you have the 10% to put down on an FHA loan. And on the 11th year, your PMI will fall off without refinancing. That is the only time. Of course, rules and laws can change. But for now, right, it's backed by the government. The PMI is permanent unless you put 10% down. But that's why FHA rates and VA rates and USDA rates are so low. They're backed by the government. A lot of the risk is taken off the investors, right? Because they're taken off, they don't have to they don't have to give you a higher rate, right? Because of risk. Okay. Standard FHA, 580 credit score and up, 3.5% down. When you go under 580, it's 10% down. Right. The DTI requirements is 620, 45 over 55% debt to income ratio. From 580 to 620, it can vary. Every lender has their own specific overlays when it comes to 580 to 620. And from 500 to 580, it's very standard, 31 over 43% debt to income ratio. Okay. When you buy with FHA, it's only for owner occupied only. Okay. You cannot buy it as a second home or an investment. You must occupy the property for at least 12 months. If you buy it after you occupy for 12 months, now you can convert it into an investment property. People ask that question all the time. For all the house hackers out there, I know the minimal down payment is 3.5% down. So you come in with minimum down, but you got to move in it. There's something called an occupancy check, which they don't do often, but if they came to the property and they did an occupancy check and you do not live there, right? That is a huge lawsuit. That is a huge fine, right? You go to Bootyville for that, right? So it is a crime. It's not a typical crime. Occupancy fraud is a huge crime. Okay, so make sure you understand when you buy FHA and you're trying to house hack, you got to move in it for at least 12 months. Okay, and you can use an FHA loan to buy a single family home, a townhouse, a condo, but make sure that condo has either a spot, it's either FHA approved, or if it's not, you got to do a spot approval. Okay, we'll go back to condos in just a second. You can go duplex, triplex, or fourplex, and you can go buy a manufactured home with a FHA loan. Remember, the condo, it has to be FHA approved. And if it's not, you must get a spot approval. So that's when sometimes you got to go to the big banks. You got to go to the loan depots, the guarantee rates, right? The New American Fundings. They just specialize. Movement Mortgage, they specialize in spot approvals. They have a whole spot approval team. So if you're in the direction of buying a condo and you're going to use an FHA loan, make sure you're working with an experienced real estate agent that can look up, hey, this condo is FHA approved. If it's not, make sure you talk to a lender and you start working on that spot approval. Give me 1 second, Andy. Let me scroll up here really quick. 1 second, guys. Oh, we didn't go over jumbo. Oh, we missed jumbo, Andy. All right, cool. All right, so let me go over FHA here. I knew something was wrong. Let me finish FHA. So FHA, I knew there was something wrong, guys. I want to go back to it. So the pro about an FHA loan, you can buy with 3.5% down, right? Unless you have under 580. 3.5% down. That means you can buy duplex, triplex, and fourplex, which you can't do with other programs, with conventional. Okay, so it's really important that you understand the power of FHA, but also know their guidelines to make sure that you qualify to buy. All right. We forgot about one of the programs, the jumbo loan. So a jumbo loan is when you buy a home in an area where you exceed the conventional loan limits. If you exceed the conventional loan limits, the next step is a jumbo loan. So depending on where you want to buy, type in conforming loan limit 2000, whatever year you're buying in, right? Conforming loan limits. If the area you're buying in, they have a specific loan limit. If you go above that loan limit, it's called a jumbo loan amount. So if you go $1 over, you got to follow the jumbo guidelines, right? Typically, jumbo loans are above conforming loan limits and they're portfolio loans, which means every bank, every investor has their own specific guidelines. They're very similar, but everyone has something a little bit quirky, a little different. If you go to a credit union, you go to big banks, mortgage brokers who brokers to other wholesale lenders. They have their own guidelines. So when you go above the conforming loan limits, definitely whatever lender you're working with, hey, I need to know the guidelines. So if you know how to qualify for home ownership, if you haven't downloaded our Ultimate Mortgage Guide, go to whatsamortgage.com and download our Ultimate Mortgage Guide. In our guides, it will tell you it will tell you how to qualify for any program. Right? What's the debt to income ratio? What's the middle credit score? How are they going to use the income? How can I use my assets for my down payment? Right? Every program will have their own DTI, income, credit, asset. If you understand that, you'll know how to maneuver. So you go with the jumbo loan, doesn't matter what portfolio they're part of, right? It doesn't matter. Once you understand how it works, you understand I can qualify for this. So here's some standard guidelines, though, if you're going to go with a jumbo loan, right? Typically with jumbo loans, they want a 660 credit score and higher, right? Prefer 720 if you want to get something with a respectable rate and a respectable payment that you like, right? Typical debt to income ratio, 43/43, right? Sometimes no room for debt if you're going with the max mortgage payment, okay? But some are even stricter, 31/43, right? Maybe you're gonna buy for 2-3 million, right? When you start getting into the 2 million, the 3 millions, the 4 millions, right? They allow lower debt to income ratios, right? When I see 43/43, I'm thinking it's probably like $1 million loan amount, $1.5 million, right? But when you start getting the 2-3 million, that's when things change. Also, when you go to jumbo, typically 10% down or more. Of course, when you get in the higher loan amounts, it might be 20% down or 30% down. Let's say you buy a house for $5 million. Sure, it's going to be 20 to 30% down, not 10% down. You buy it for 1.5, 1.6, 2 mil, 1.2, it could be 10% down, right? That's why when you go with these jumbo products, you want to talk to your lender, right? And you want to find out what are the parameters so you can prepare for it. Typically with jumbo loans, you can buy single family home, condo, townhouse, right? You rarely see units because when you buy units and you go in FHA or conventional loan, they allow higher than the standard loan amounts when you're getting into duplex, triplex, and fourplex, okay? With jumbo, you can buy owner occupied, second home, or investment. Jumbo loans are more diverse. You don't have to be owner occupied, right? But of course, when you go second home or investment, it is a higher risk. Okay, so make sure when you go jumbo, you want to know all the guidelines up front, right? You want to know all these pain points and these hurdles so you can start attacking it right away, right? I see a lot of people, right, follow specific, oh, I'm going to do this, I'm going to do that, right? But they don't know the guidelines. They just know either someone posted something on the internet and without knowing the details, right? And they follow that information and all of a sudden they don't qualify. So it's really important that you understand, find the pain points. And the best way to find them, you want to go to our whatsamortgage.com and download our ultimate mortgage guide. If you have a question tonight, I will make sure I answer your question at the end of this live. All right. Hopefully that helps you out. So let's talk. What? Please comment the questions though, and I'll definitely answer when I'm done. Let's get into the fourth loan program. Okay. Conventional loans. Let's talk about conventional loans here, right? Conventional loans, it's not backed by the government. Even though Fannie Mae and Freddie Mac run it, it's a different type. They're with the government, but they're not really with the government. It's not backed by the government. That's the reason why they treat their interest rates different and the MI a lot different. It's like they're backed by the government, but they have more freedom than FHA, VA, and USDA, okay? The minimum credit score, 620 and up. But if you talk to anyone who's buying a home with a conventional loan or talk to any lender, any real estate agent, they're really not going to look at a conventional loan if you have under a 660 credit score. Most likely, you're not going to pass their automated underwriting. You'll probably have to go to manual underwriting. And right now in a seller's market, or if you're buying in a seller's market, they're probably not looking at any manual offers. They want to look at automated offers, right? They want that guarantee, that automated, right? You can use a conventional loan to buy a owner-occupied, a vacation home, or rental. The max debt to income ratio, 45/50. But when you're under that 700 credit score, that DTI starts dropping to 45/45, right? If you go into that 660, right, and 660, 680, you might be 45/45 or 43, right? So conventional loans, where the automated underwriting gets really sticky is when the FICO is under 700. So when you go conventional, when you keep it above 700, you'll get to do the 45/50. But when you dip under the 700, it gets very sticky, right? Let's say you don't have a lot of reserves, right? Or a lot of credit. When you get under 720, it can get sticky. So conventional ones, you really want the lender to run the desktop underwriting or the loan prospect ASAP. Fannie Mae runs DU, right? Desktop underwriting, and Freddie Mac runs LP loan prospect. So depending on which direction your lender's taking you, I want a copy of the DU. I want a copy of the LP. You want to make sure that they scrubbed against your credit and you have that automated approval, and you'll see approve eligible, right? Or the loan is approved, right? It's doable. So you want to make sure that happens, especially as you're out there writing offers. The cool thing about conventional loan for owner occupied, right? If you put less than 20% down, you will have PMI, but the PMI is not permanent. Okay. If you put 20% down, less than 20% down, you will have PMI. You put 20% down, there's no PMI, right? So when you put less than 20% down, you have PMI, but it's flexible. You can find a way to get rid of it without refinancing. That's why a lot of people choose to go conventional, because what happens down the road when they have the equity, but rates are higher? So do they sit with their PMI still? They hold on to it because because rates are higher, or if rates are higher, they might have to wait for enough equity for the PMI to fall off automatically. There's a lot more versatility when it comes to conventional loans with PMI. Right? You can use a conventional loan to buy a single family home, a townhouse, condo, duplex, triplex, or 4-unit, right? When you buy a condo, the condo must be warrantable. Okay, if it's not warrantable, now you're going to get into a non-qualified mortgage, which we'll talk about in a second. Okay, so it's important that you know that when you go conventional and you go with a condo, that thing must be warrantable. Right? Warrantable. So also pros, like I said, the PMI can fall off in time, so you have to worry about refinancing it. And when you're buying self-employed conventional, right, owner occupied, and you don't own other properties yet, right? You're buying your first property. You don't have rentals, right? You can go 1 year self-employed as long as you've been self-employed for 5 years, or you've owned the business longer than 5 years. Okay, so with a conventional loan, gives you a lot of flexibility to do more things when you're buying with conventional. And let's talk about the final program, the 6th program. Okay, the non-qualified mortgage. So this right here, warrantable. Yes, what is warrantable? Warrantable, Jolene. Warrantable is when the condo passes a certain questionnaire. So something called an HOA questionnaire. And if it doesn't pass this questionnaire, the condo is not warrantable by Fannie Mae or Freddie Mac. That means they will not insure the condo. Okay, that means you cannot go with a Fannie Mae or Freddie Mac loan. So the other option is a non-qualified mortgage. All right, let's talk about non-qualified mortgage. So with non-qualified mortgage, it's very big right now. Typically, they're used for self-employed people. And the 3 most common programs is a debt service coverage ratio. That means you can buy a rental property, and that's why so many investors are buying rental properties with debt service coverage ratio, right? They don't have to go hard money. As long as the property rents positive, right? Let's say the mortgage payment is $2,000, the rent's $3,000. They let you use 100% of the rent, right? And you got to have good credit, and you have to own at least a owner-occupied home. Debt service coverage ratios, and there's no tax returns required. Great program, right? Debt service coverage ratio. Another one, 24-month bank statement. If you are self-employed, you can use your business bank statements. If it's business bank statements, you can use 100% of your deposits, not transfers, but deposits, right? Or 50% of your personal deposit. Last but not least, asset depletion. So if you're getting a loan for $500,000, but you have $500,000 in the bank, then you are good to go. Okay. And also, they use that as income as well. Your asset depletion. There's a math formula that they'll say, hey, this is my asset depletion. This is how much is going to be used as income to qualify for the other property. Let's say you're a wage earner. The common reason wage earners use non-qualified loans is non-warrantable condos. Like I said, or if there's a bankruptcy less than 2 years old, let's say they file BK, the BK is only a year old or 6 months old, but they qualify with their income, non-qualified mortgage will let you buy with a bankruptcy. But typically you're going to have to put either 10 to 20% down depending on who you're getting the non-qualified mortgage with, right? Non-qualified mortgage is an alternative to hard money loans. They became very popular in the last 2 to 3 years, but last year it was probably the most popular because of the debt service coverage ratio, right? Non-qualified mortgage are typically 0.75 to 1% higher than conventional interest rates. That's why people love them, right? When rates were in the 3s, they were giving out these 24-month bank statement loans in the 4s, right? I even see them in the 3s. Also, when you get these non-qualified mortgage, typically they're going to charge you 1 to 2% of the loan amount. I had one guy call me yesterday and said, man, you got to help me find a better deal. They're taking advantage of me. I'm like, oh my gosh, tell me more about it. He's like, it's a bank statement loan. So I asked the guy, brother, so you are evading Uncle Sam. You do not want to pay taxes. That's why you're self-employed, correct? So you're not paying any taxes. You're not showing any income. That's why you have to go 24-month bank statement. Yes. So you don't want to pay taxes and you have no proof of income, but you are upset they're giving you a 3.875% interest rate. And I'm like, are you kidding me? Come on, 3.875. Oh, they're charging me 2 points. You are a risk, right? So remember, when you're getting these non-qualified mortgages, these stated loans, these hard money loans, they are taking a risk. If you avoid Uncle Sam, you can't avoid high interest rates. If you avoid high interest rates, then you got to pay Uncle Sam. It's one or the other. You can't win both, right? So remember that when you're getting these loans, you want to be a reasonable person. No one wants to work with a client or a consumer who's not reasonable. So make sure you are reasonable when you're qualifying for these non-QM programs, all right? So that right there is our 6 mortgage programs. We have USDA, we have Jumbo, we have VA, FHA, conventional, and non-qualified mortgage. When you're out there trying to qualify to buy a home, it's going to fall under one of the 6 programs. It is rare. It is very rare if it's going to not fall under one of the 6 programs, all right? If you are going with a down payment assistance, it's either going to be a conventional or FHA guideline. Remember that, right? Like, well, there's other programs out there. I'm telling you guys, 99, unless you're doing a hard money loan, 99% of the programs, yes, other programs, they might offer like interest only, 5-year arms, right? But the guidelines of the programs will fall under one of the 6, unless it's hard money. I promise you that, right? If this is residential, it will. And if you want to know how to qualify for any program, because there might be an overlay. You might want a specific down payment assistance, or there's a specific conventional or specific FHA in some city or state. They're gonna fall under the guidelines from the Ultimate Mortgage Guide, right? Debt to income ratio, credit, income, assets. So definitely go to what'samortgage.com and download it. Hopefully that brought you value, guys. If this video brought you value, do me a huge favor. Save this video, share this video, and like this video. And if you're not following us by now, hit that subscribe or notification button so you're notified every time we post a new video. All right? So now, you know how all loan programs work. Then now we're going to talk about, right, the biggest battle in mortgage industry. The battle of FHA versus conventional, right? This is where people ask me this question. Man, should I go FHA or should I go conventional, right? Well, everyone has a different scenario. Either go FHA or conventional, right? If it's in a rural area, you're going to go most likely rural. If you're a veteran, most likely you're going to go VA. You're self-employed and you didn't pay Uncle Sam, most likely you're going to go with a non-qualified mortgage. If you go with a specifically high loan amount, mostly you're going to go jumbo. So the one that it's kind of in the same territory is FHA versus conventional, right? Guys, bring on the questions. I will answer the rest of the questions at the end of this episode. All right, guys. Also, guys, if you haven't followed by now, hit that subscribe or notification button so you're notified every time we go live or post new content, right? Also, this is an interactive channel, so ask a lot of questions, and I will be answering. Okay, let's go after it, right? So number 1, in my guide, you will understand my number 1 rule is budgeting your mortgage payment. So it's your debt to income ratio. FHA allows 45/55, conventional 45/50, right? So you can see FHA is more flexible. So typically if you have a higher amount of debt, right, FHA might be for you. Okay, conventional, they're not that aggressive when it comes to debt, right? So if you had, let's say you made $10,000 a month, FHA and conventional if you have no debt, you can afford a $4,500 mortgage payment max. I don't recommend it to go max on your mortgage payment, right? But if you had to, $4,500. But on FHA, you did have debt. They allow you an extra $1,000. Conventional, only $500, right? So conventional, a little bit more conservative. Let's talk about credit. All right, with FHA, credit goes down to 580, conventional 620. FHA, you want to be in that 620, 640, conventional 660, 680, I think more 700, all right? I'll answer that in just a second. So you can tell FHA, a lot more aggressive, right? They have looser bankruptcy guidelines. Chapter 711, wait 2 years. Conventional, you got to wait 4 years. Chapter 13, wait 1 year, right? Chapter 13 means you're reconsolidating your debt. You're still going to pay it. You can buy after 1 year. Conventional, 2 years. Short sales, 3 years, and foreclosure, 3 years. Look at conventional, 4 to 7 years. All right. So when it comes to like bankruptcies and credit, seems like FHA is beating conventional all day long. But let's check this out. On an FHA loan, if you want to omit a debt under 10 months old, that debt has to be below 5% of your gross income. So if you make $5,000 a month, that debt that's under 10 months, if it's over 250, you still got to add that debt. Under 250, you can omit it. Look at conventional. If there's less than 10 months left, boom, you can omit it. There's no 5% income rule, okay? Look at omit for cosigners. So on FHA, if you cosign for somebody, like a car, especially I'm talking about a car, if you are the main person on the car payment, even though they're making the payment and they made 12 months payment, you cannot omit the payment. You got to be the cosigner and not the main. On conventional, it doesn't matter, right? For homes, for a property, they can't tell if you're the main or the co. But for a car, they can tell if you're the main or co. All right, makes it so conventional a lot more aggressive when it comes to showing proof that someone else made the payment because you co-signed, right? You must meet 12 months checks, right? Also, IRS, FHA wants proof of 3 months. You've made 3 payments before you can account that debt and qualify to buy. Conventional, as long as you have an IRS payment letter, then you can add that payment to DTI. You can qualify to buy. So FHA, you got to wait 3 full payments. That's why FHA a lot more aggressive when it comes to credit score and bankruptcy, but when it comes to omitting debt, right, or more flexible with monthly liabilities, conventional wins. Okay, now let's talk about income. With income, FHA, you can gross up fixed non-taxable income to 125%. Conventional, 115%, right? But with FHA, when you're self-employed, you got to go 2 years tax returns. With conventional, you can go 1 year self-employed. If you've been self-employed for over 5 years, you can go 1 year tax returns. That means if you're a self-employed person, you got to suck it up and file 1 year tax returns, but you can't write off everything. As long as you've been self-employed for over 5 years or the business has been around for 5 years. All right. So it's important that you know that. So when you go conventional or FHA, you know, okay, I am self-employed. Which direction do I want to go in? Right. If you're on non-taxable fixed income, FHA is going to be more aggressive with giving you more income. So those are the requirements. I'm sure there are other income ones. These are the main ones that I see the comparison, right? Let's talk about down payment now, all right? This is down payment. FHA, the donor's gift always must be sourced. No matter if you wire it directly to escrow, right? You got to source it from the donor, right? The cool thing about down payment for FHA, let me go back. On conventional, if you do gift funds, if you wire the funds directly to escrow, your donor does not have to show any bank statement. There's no sourcing with conventional. FHA, you got to source it no matter what. But on conventional, if you wire it to whoever you're gifting it to and they wire it to escrow, you got to source those. All right. With down payment, FHA, 3.5% down on duplex, triplex, and fourplex. Pound for pound, they're going to be conventional. If you go owner occupied conventional, you got to go 15% down to 25% down, right, for a triplex or fourplex. With FHA, the donor can cover the down payment, closing costs, and pay off the buyer's debt. On conventional, you can only cover the down payment and closing costs, right? For owner occupied, for investment, completely different game. So those right there, you compare, if you have down payment, how to compare it, right? Next one, private mortgage insurance. FHA, there's upfront MI, monthly, right? 1.75 right now. If you're looking at this, November 2021, there's a monthly MI. Doesn't matter where your credit is. It's going to be 0.85. If you do less than 5% down, 0.80 at 5% down. Unless you put 10% down, the PMI will fall off. On conventional, the PMI is flexible. It's cheaper when you have better credit, right? That's why I recommend if you have above a 700 credit score, the PMI is cheaper on conventional than it is on FHA, right? And the conventional PMI, it's not permanent. It will fall off without refinancing. So you don't have to eat up more in your equity to refinance from FHA to conventional, right? Conventional, the thing will fall off in time. Occupancy, FHA, owner occupied. Conventional, right? Owner occupied, vacation homes, investment homes, a lot more diversity with conventional, all right? Let's talk about some negatives here. With an FHA loan, You got to run the spouse's credit. So if even your spouse is not going on the loan, you got to run this credit in community states. Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin, right? Another negative thing about FHA for anyone who's buying, oh, I want to buy my next house with the minimal down of 3.5. There's a 100-mile rule. So if you have a house and you want to vacate it to buy your other house with an FHA loan, if the house is within 100 miles of your current home, you cannot use rental income to help you qualify because they're of the 100-mile rule. Also, FHA has a self-sufficient rule when it comes to triplex and fourplex. You run into this problem in California all the time, right? You don't run to it on the East Coast, okay? You don't run to it in the Midwest. So with the self-sufficient rule, 75% of the gross rent of all the units has to be more than your mortgage payment. That doesn't happen when you look at $1 million, $1.2, $1.5 million 4-unit in California, right? So it all depends. Maybe you might get away with it in Fresno, right? But you're not going to get away with it in San Diego, LA, or Orange County, or San Bernardino, or Riverside. Typically, if the units, the triplex or 4-unit is over 550, 600, it won't rent positive. Well, rents have gone up, but even rates are climbing up as well, and loan amounts, right? So definitely make sure you follow that self-sufficient rule when you're buying triplex or fourplex. People I see go to escrow and they realize, oh, the self-sufficient rule just knocked them on their butt, right? I'll go over that in just a second. Conventional typically have higher rates than FHA, VA, or USDA, right? So those are the negatives. So that right there, my friends, is the big battle between FHA and conventional. It all depends on what you fall under. Each program has its little niche to help you qualify for more home or even qualify at all, or it's a better situation for you. All right. If you have more questions regarding should you go FH or conventional, always give us a call or DM us or text us 714-790-9697. If you found this information valuable, do me a huge favor, save this video, share this video, and like it. If you're not following us by now, please hit that subscribe or notification button. All right, guys, let's give some Q&A here, right? I'm going to go over everyone's questions. All right. Let's go over everyone's questions. Fred, is the video stuck? You hit refresh, hopefully. All right. Lucy, hopefully you hit refresh. Thank you, Rose. Natalie, what's going on? Thank you. What about a roommate? What is the question? What about the roommate? So,
I think they're asking if you
what?
mentioned a roommate.
What do you mean roommate? Ask that question again, Lucy, about the roommate. If you have any questions, leave a comment. That's me. Sorry. That's me, VA. What's going on, Lucy? What is the roommate? Oh, so, Lucy, if you buy a home with a VA loan, your roommate, right, cannot help you qualify to buy unless your roommate is your spouse or they have VA benefits as well. So it's another veteran that meet the VA requirements. They can help you co-sign. But if your roommate is not a veteran, they cannot help you qualify. Hopefully that helps you out. All right, what is the conforming loan limits for 2022? So, Alan, here's where we talk about. Me and Andy went back and forth on this all day long. We're putting together a video. So right now, the conforming loan limits is 548, 250, which means if you want to go with the minimal 3% down, you can buy a house for $565 with 3% down and not exceed the conforming loan limit of $548, $250. I think 3% down of $565 is like $548 and $50, right? In 2022, the conforming loan limits are going to be $625, which means you can buy a house up to $644,000. So for the areas that don't have high balance like San Diego, Orange County, or LA County, right? Woo! Riverside, San Bernardino. This guy's going to affect you guys big time. Now you can buy a home for $644,000 for just $19,000. That's big time. Check this out. So right now, if you bought a home for $600,000 and you want to go conventional, right? And you don't have a high balance area, like you're not in Riverside, San Bernardino, or LA County, on a $600,000 purchase price, you have to come out of pocket $52,000, right? You have to come in with 3% down and you can't exceed the 548, right? So that's huge. If you go in 2022, when you buy for $600,000, the out of pocket for down payment is 18 grand. So if down payment was the reason why you can't buy your home, just got solved in 2022, right? A lot of people can't buy the home either. They can't afford the monthly payment or they can't come up with a down payment. With inflation, with price of homes going up, right? And cost, it's hard to save money. So a lot of people can afford a higher payment. That's why rent's going up, right? But they just can't afford to save money because of the higher rents and the higher costs. But now, boom, 18 grand, 600,000. 644, about 19,000, right? So it's solving a bit. Let me double check this here. It's a big issue, right? It's a big issue. Let me see here. 644, 123, minus 3%. Yeah, so 644,000, 3% down is about a little bit over $19,000. So your loan amount would be 625, right? That makes it a big difference. And of course, Orange County, LA, San Diego, they're talking about that. Alaska and Hawaii being 935. That's not confirmed yet. So that's why I haven't said it yet. But everyone's talking about 935. They're talking about Alaska and Hawaii, but I didn't see them include LA and Orange County and San Diego yet. But we're waiting to see. But my boy Bill says they have. So we talked about it in Bill's show. Hopefully that helps you out. Lucy, if you have a 800 credit score for VA, do you get lower rates? So and how long do you have to wait to refinance if you buy a 4-unit? So Lucy, if you have above a 660, 680, depending on the lender, all rates are going to be the same for VA, right? So today you're at 2.5 to 2.625, unless you want closing costs covered, all right? So if you have a 700, 800, or 660, the rate will be the same. So, other question, if you buy a 4-unit with a VA loan, right? Owner occupied for FHA, it's 3.5%. So you need 3.5% to go from VA to FHA. If you want to go to conventional, you would need 25% equity. So the timeline would be how much equity you would have, right? So of course you would have to live in the property for at least 12 months. After 12 months, it's about if you want to convert it to an FHA loan or conventional loan. FHA, you need to have at least 3.5% equity on conventional, 3 to 3.5% equity on conventional. You need 25% equity on a 4-unit. Hopefully that helps you out. Do you have this recorded? Giselle, this will be on our YouTube channel. That's why you got to follow us on YouTube. Guys, do me a huge favor. If I brought you value tonight, follow me on YouTube and TikTok. We really need the subscribers, all right? Hopefully that helps you out. Hopefully that helps me out. What's going on? See here. How do you determine conventional loan limits? I don't determine them. What's it called? FHFA, they determine the loan limits, right? So every year they change it based on inflation, right? That I could be wrong, but I think it's FHFA. They determine the loan limits, and every year that can change, right? Fannie Mae, Freddie Mac, I'm sure FHFA, they powwow together. Fannie Mae, Freddie Mac, like what are loan limits going to be? Where have things increased? All right. We don't decide it as loan officers. The mortgage banks don't decide it. It's decided by, the people above, and then they just release the guidelines. Everything's pie. How do you feel about using a friend as a mortgage broker and realtor? I don't think, I don't like working with friends, everything pie. The reason why, I don't want to even do my brother's loan. I don't want that heat, right? It's going to mess up the relationship. No matter how good of a discount they give you, you're not going to be happy because someone else is going to offer you a better deal and you're going to think your friend ripped you off. Also, when you're dealing with a friend, sometimes I see it happen a lot, especially with family members. If you don't like something, you don't tell them. And then you build up this this bitterness, all right, or animosity against them. I don't highly recommend it if you want to keep them as a friend or family. Unless they're a distant friend or family, or it's like a refer. I wouldn't even mess with it, right? I've seen it ruin so many relationships. So I love my brother. I'm giving him guidance. I would not touch his loan, right? Because I don't want, no matter how good of a job I do or don't do, right? Or if he doesn't like something, he's going to feel awkward just asking me. That's why I don't recommend it. Hopefully that helps you out. Elizabeth, thanks to your advertisement and info, I was able to purchase my home. Congratulations, Elizabeth. I'm so proud of you. Can we clap for Elizabeth really quick, guys? How do you feel about using a friend or answer that question for Everything's Pie? Thank you so much, Elizabeth. Gus Ayala, what a house 650 conventional, would that be jumbo for me? Like I said, right now 644. So if you are buying a home for 644, right, the down payment would be 18 grand, and you would have to come in with a $6,000 difference. Okay, so 18 grand plus 18 grand plus another 6 grand. That's what you need to come in with, and you don't have to go jumbo, right? As long as you keep the loan amount at 625, you are good to go. So you buy 650, minimum down payment is the 18 grand plus the difference. All right, hopefully that helps you out. Sherry is amazing. Thank you so much, Elizabeth. Danji Dab. Can you tell me what pros and cons on new build? So what I do like about new construction, it's new. There are things that can go wrong, but very slim to none, and pretty much you have the builder's warranty. That's why I like new construction, right? The con, you're probably going to pay a high HOA. You're probably going to pay Melrose, right? You're going to pay for more, but you pay for what you get, all right? Hopefully that helps you out. I do like new construction. My first home was a new construction. I wish I would have known more about how to buy new construction, but I do like new construction. The home that I live in now was built in 2012, right? So it's not the new, but it ain't the old, all right? Hopefully that helps you out. Everything's pie. Which loan do you recommend buying land and placing a new manufactured home in Northern California? So typically, if you are buying land, you would go with a land loan. Then you would have to get it zoned before you put a manufactured home on it. So you would have to start with a land loan, which is about 25 to 30% down to buy a home with a land loan. And then you would have to go through the city, go through the county, get permits to put a manufactured home on it. Hopefully that helps you out. A copy of LP. Yes, loan prospect. What is it? So when you buy a home, Jolene, unless you're going to go with a non-QM or a jumbo loan, they'll either ask for the DU with the desktop underwriting or the LP, which is the loan prospect. Typically, when you go with a Freddie Mac loan, Freddie Mac loans don't issue DU. So USDA will issue a GUS. Fannie Mae, FHA and conventional would mostly issue you a DU. If you go loan prospect, they would issue you an LP, right? Or with FHA, they issue something called a scorecard as well. Everyone has their own little system. A lot of times, sellers that have loan officers as cross qualifiers, they'll ask for that just to make sure that the buyer qualifies. Can you be my agent when I'm ready to buy a home? I do not do real estate. I do loans, but if you want to run stuff by me as a loan officer, I do have a team I work with. If you want me to quarterback it, just let me know. All right, give us a call, 714-790-9697. You can always call us, text us, or email us at info@whatsupmortgage.com. Especially if you have a loan estimate out there. If you're not following me on Instagram, every morning so far, I've been giving a rough estimate where rates should be. I'm telling you this so you kind of have a ballpark so you know you're not getting hustled or overpaying for a loan, right? I got some hate message from a lady saying that, oh my God, you're breaking this. You might be breaking the rules, right? I'm not trying to break a rule. I'm not giving an exact quote. The only time I give an exact quote is when you guys give me a scenario and I post it on Instagram, but I leave an APR. I'm just giving you a ballpark where rates should be, all right? But of course, if you are shopping for a home, I would definitely talk to a lender, get whatever rate they're going to give you and get a second opinion, right? But I'm giving you a ballpark, mostly on owner-occupied for conventional, FHA, or VA, all right? Hopefully that helps you out there, guys. Warnable. Jolene, I think I answered that earlier. Warnable. So when you buy a condo with a conventional loan, it has to be warnable, or Fannie Mae or Freddie Mac won't insure the condo, right? So if it's not warnable, the only way to buy it is non-warnable. So typically, let's say if more than 50% of the owners are investors into the condo, it is not warnable. If more than one entity or one person owns or group owns more than 10% of the units, it's non-warnable. What does that mean? That means, let's say you have 10 units. Let's say you have 100 units. If more than 10 are owned by a party, that means you can sway the HOA. It's non-warnable, right? If you have delinquencies against the HOA, like 3 months worth of delinquency, everyone's different, right? Then it's non-warnable. If you have any litigation that affects other units, it's non-warnable, right? A condo can go from warnable to non-warnable or non-warnable to warnable, depending if they solve all their issues. Hopefully that helps you out. Gus, can Daca recipients buy with FHA or conventional? Yes. Starting in 2021, I think 2020, Starting 2020, 2021, Daca, you can go conventional, but FHA, you can do that all day long. I mean, conventional FHA, you can do it all day long. All right. Everything Pi, best loan for buying a distressed property that needs repairs before moving in. Of course, if you can go VA, you can use a renovation loan. If not, FHA. FHA 203K is a lot more aggressive than the conventional one. Hopefully that helps you out. Gus, buying 3 to 4 unit FHA, so they need to qualify a loan with their rent. Yes, there is a self-sufficient rule, Gus. Of course, if you buy outside of California, there's a high chance you're going to pass the self-sufficient rule for all the house hackers out there, okay? But when you buy in California, it probably ain't going to pass the self-sufficient rule. That's just 100. When you go duplex, there's no self-sufficient rule, all right? Everything Pi. If I want to purchase my home under an LLC, can I still qualify for an FHA owner-occupied first-time home buyer? So, if you buy a home, you have to personally guarantee it. So you have to buy it under your social security number first. You personally guarantee it. Once you buy it, you can put it in an LLC. But typically when someone puts someone in an LLC, it's a rental property, right? Or because you don't want anyone getting hurt, and then they come sue you, right? Or you get good renter's insurance. If you're buying a home and you're actually going to keep it, I would look at a living trust. Only LLCs is you're going to put it into you're going to eventually rent it out. Jasmine. Hello. So for conventional, we don't have to put 20% down, but we will have higher rate. Jasmine Rodriguez, great question. Hello. So for great question, Annie. I want to record this one. Jasmine Rodriguez, great question. Hello. So for conventional loans, we don't have to put 20% down, but will we have a higher interest rate? This is how it works on conventional loans. When you put 3% down, rates are a little bit higher. When you go 5 to 15% down, rates are lower. At 20% down, rates are a little bit higher because they know your MI is coming off. It's kind of quirky. But when you go 25% down or lower, rates will drop again. Okay? Hopefully that helps you out. Everything Pi. How can an LLC affect your home purchase and loan selection? So, when you buy a home, it's under a personal guarantee. If you get a traditional mortgage, you're not getting a business loan, but a traditional mortgage, you are buying it with a personal guarantee with your income and your credit. Okay? It doesn't matter what program you buy it under. You can put it under an LLC. But if you put it under an LLC, I wouldn't recommend you do that till after 12 months because you are signing a piece of paper saying that you're going to live in the property for 12 months when you are buying it owner-occupied, if you are buying it owner-occupied, unless you buy investment, right? People get that LLC to protect all your other assets, right? If something goes wrong with that property, right? Someone gets hurt, there's a lawsuit, anything happens, they only can sue the LLC. They can't sue they can't sue you or any other property or anything else you own, all right? Hopefully that helps you out. Can you explain how to calculate a debt-to-income ratio? So Alfredo Hernandez, can you explain how to calculate a debt-to-income ratio? So you take your monthly gross income or the monthly gross income of whoever is going to be on the loan, okay? You times it by 45%, right? If you have no debt. That's the max mortgage payment. So if you make 10 grand a month, you times it by 45%, which is $4,500. Then you times it by 50%, which is $5,000. So you're allowed up to a $4,500 mortgage payment with $5,000 a month in debt. I mean, $5,000 in total debt. So if you have no debt, $4,500 is max. But if you have some debt, $5,000 would be your max. That means your mortgage payment, tax insurance, and all your monthly debts can exceed 50%, which is $5,000. Okay. If you go with a government loan, you can go 45 over 55. So a little more flexibility, right? Depending on the program, like we talked about, jumbo loan that have lower DTIs. Same thing with USDA loans. Hopefully that helps you out. If you have more questions, Alfredo, give us a call or reach out to us. One of our someone from my team can help you see what you qualify at. 714-790-9697. Everything Pi. What's the best way using crypto for down payment? Oh my gosh, I've been waiting for this one. Oh yeah. Okay. If you have crypto, all right. And I know right now, no one wants to dump their Shiba, I'm kidding, right? If you don't want to dump your crypto and you want to use it, you can get something called a portfolio loan or a line of credit on your crypto, depending on the brokerage you're with, up to 60% of your portfolio. Draw that money out, right? Put that in your account. Wait 2 months so the lender doesn't ask you where you got the money, since it's not a securitized asset, right? They don't want to know. So just put the money in your account for 2 months and you're good to go, right? But you can draw a portfolio or a line of credit without having to sell your crypto, right? You're sitting there, you're chilling on some what's it called, Ethereum or Ethereum or Dogecoin or Dogcoin, right? Or any, yeah, right. If you're sitting on any crypto and you don't want to sling it, right? Get that portfolio loan. They're out there. Call your brokerage right away, whoever you have your money with. All right. Hopefully that helps you out. Been waiting to answer that one. I live for crypto questions now, right? Jose, how long should we apply for a loan before buying a home? I would apply 2 to 3 weeks before you start shopping, right? If you apply and you qualify, start shopping. If you don't, you have time to kind of work on whatever you need to work on to qualify. Hopefully that helps you out. Quentin, if someone adds me as a user on their credit card, would that help my FICO? That it's lower than my credit score. What can I do to help my FICO? So, Quentin, if someone adds you as an authorized user on their credit, make sure it has a long history, it's paid on time, and a low balance, right? If they do that, it helps your credit score. Okay, so hopefully, if you do that, it helps your credit score. Or pay down some debt. That helps out too. All right, hopefully that helps you out. Jadar, what is the advantage and disadvantage of renting property, especially when you decide to sell after many years? So what is the advantage and disadvantage of rental property, especially when you decide to sell after a couple years? Well, the disadvantage is you sell it, you can't collect rent anymore, right? Also, when you sell on rental property, there's taxes you got to pay on the equity, right? Remember, on owner occupied, it's a little bit different. You have that 250, 500 rule, but on investment property, you're going to pay the gains, right? The advantage, you can transfer it to another property, right? If you want to keep upgrading and buying more and more property and not pay the gains on it, right? So hopefully that helps you out there. Alan, I'm living for these questions too. SB9. 2022, everyone thinks this SB9 is like the second coming of Jesus. Let me tell you. So SB9, there's 2 ways. You have to be on a single family zone lot. Okay? Single family zone lot. You can build a duplex right next door. You got to live in your single family home or at least one of the units and you can rent out the rest, right? Or you can split the lot in 2. Each lot has to be minimum of 1,200 square feet. After you split it in 2, you can build a single family home and a duplex and another duplex on your lot. So now you got 4 properties on a single lot you split in 2. Here's the problem. Any property in California, right, that is able to split the lot is probably in a nice area that doesn't want to split the lot. Okay? The reason why also, right, so let's say you're in an area. You need to pull the cash out to build on the property, unless you're going to let an investor come in and try to sign a note with you saying that, hey, they'll do everything for you and they want to make profits on it, right? It would be hard to find a property with a lot of equity that someone's going to want to split the lot, right? There'll be people who want to split their lot, but they might not have the equity. It might not be worth enough with the current balance on their home. But there are some. There might not be a lot. And the most important thing is you got to live in it for 3 years. As soon as you get your approval, right, to either build or split the lot, you got to live in it for 3 years before you can rent out your property. If not, you cannot split your lot or you cannot build your duplex. So it's owner occupied only, right? It's not going to help the inventory out there. It's allowing people who complain about these slumlords to become slumlords, right? Or landlords. I'm talking smack when I say slumlords, but all the people who are talking smack about landlords, all these people are coming in our country, or these investors are buying up all these homes. Now they're allowing people less fortunate, right, or people to build more property, to rent it out. It's not solving the home buying crisis, right? It's just allowing more property for rent. Let's say someone actually falls in the category. They build this monstrosity property. It's going to drive down the value in that neighborhood if it's the only one, right? So it's going to help some people, but it's going to hurt a lot more people than it helps. And it's not solving anything. That's just my opinion. If you have your opinion on it, please let me know below. Hi, man. I know I asked this before, but is it true that builders are really delaying the construction on purpose because they intend to raise prices? I am ready to close, but the closing date has been moved more than 3 times. Right now, Mary Jane, it's just taking a long time. It is hard to find, it's hard to get material, right? Have you looked at Long Beach docks yet? People don't want to work overtime. There's not enough people working out there to bring the stuff in. Number one, so is that not making it to the site? Number two, wages have gone up, right? So it's taking, these builders are sitting there going, man, like they're trying to figure out, they might take an L on your property and how do they make it up in the next property, right? And then they got to find people to work it. Not enough people want to go back to work right now. So are they doing it on purpose? I don't think so. They just have a lot going against them. Hopefully that helps you out. What up, Lucy? Can you use roommate's income? No, you cannot for VA. You cannot use boarder rent to help you buy. If you go, Lucy, I think you asked a lot of VA questions, so I'm thinking you're trying to buy VA. But if you want to go conventional or FHA, you can use your roommate's income, but you got to qualify them on the loan as well. All right. 625, is that FHA? No, that's conventional. That's conventional. FHA loan limits typically come out right after Thanksgiving. Lucy, do you recommend buying outside our living area? I'm interested in a multi-unit, but in San Diego, a 4-unit for $1.25 million. I don't think the rent would cover that. I am doing VA. I owe my $19K in car. I have $61K in revolving credit, but I owe nothing according to the Credit Karma. I am 801. See here, car only, 61 in revolving debt, but I got pre-approved for $750 on my own, but I'm scared of a high cost in San Diego. What I think, Lucy, I would move. So if it was me and I wasn't married and, I didn't buy, like right now prices, I bought for $780, prices are at $941 in my neighborhood. Model match in escrow to close at $941, right? I probably wouldn't buy in Tustin. I'd probably convince my wife to go to Texas or Idaho or Nevada or Arizona. Yes, it is hotter. Or I would go somewhere else, right? Or not Oklahoma, Andy. I have nothing against Oklahoma. I just been there before. It's not my cup of tea. All right. If you are single and you have a chance to relocate, the most important thing, I think the most important thing in life is having peace. And the best way to have peace, not have a lot of bills until you figure out some hustle where you're making Uber's amount of money, then move back to where you want to, right? Look for flexibility first in cash flow. Right? Cash flow. Don't overpay for your stuff, right? Am I overpaying in California? Yes, I am. But is everyone else paying? Yes. So there's no way I cannot overpay. If I'm the only one overpaying, then I'm the crazy one. But everyone else is willing to overpay, right? But if you have more flexibility, Lucy, I would not live in San Diego right now, right? Unless you have a family and that's what you got to do to live in San Diego, that's what you got to do. Precious, is it wise to refinance if the new rate they offer is not even less than 1% than what you have? Take it. Precious. If someone gives you a 2.875 conventional right now, take it. I know 2.875 doesn't even exist. So if they give you 2.875 without charging you points, take it. Precious, take it. If you plan on keeping this home and loan longer than 7 years, take it. Right? Take that thing. I don't even care who the lender is. Tell me, I might go use them for 2.875. All right, take it. Good question. Thank you so much. I love how we are a community here. If there's 2 names in title and your name and if there's 2 names in title and you're selling the property, how can you get that check? Whoa. Ledesma. That's some gangster stuff.
Hey, where is that?
If there's 2 names in the title and you're selling the property, the check, the other person who's probably gonna have to sign off on you getting that check first. You cannot, if there's 2 people on title, there's no way, unless you do some gangster illegal stuff and you don't care about going to Bootyville, that will the other person not know that you're selling the property. And they're gonna have to prove where that check's going, right? Before they cut any checks. All right. But if they approve it, you're fine. But if they don't approve it or they want their name on it too, that's or you can have the check cut to a joint account or a trust and then have that trust distribute the money. But man, yeah, there's no way without the other person knowing. All right. Heaven is mine. How can you determine whether the homeowner or bank can include closing costs? So talk to your lender, right? Whether the homeowner, you can ask them if they want to do it. They say yes or no. Banks typically you're like, hey, can you give me a rate to cover my closing costs? They can tell you yes, but you qualify for less because your DTI goes up. With the bank, talk to the lender, ask them what is the rate I got to get to cover my closing costs. Just talk to the seller. In a seller's market, they might not even respond back to you, but it never hurts to ask, right? Some people say, oh, you don't ask, you might not get it. If you reach out to a seller agent and depending on the market and you tell them you want closing costs, they might not even look at your offer, right? Unless it's a home that's been on the market for like a month or two, then they might. All right. But some people are like, oh, you should always ask. Well, to each their own. Danny, how can learn about how to purchase new build? Definitely you want more to buy a new build. If it was me, I recommend you qualify through their lender. The reason why, because most likely you're going to have to cross qualify anyways. Qualify through their lender first. Find out what credits they're giving you. Then reach out to a couple mortgage brokers, right? Or small direct lenders out there. Most likely a mortgage broker or a small direct lender will beat the builder, right? Not always, but a very high chance. But I would use the credit score from the builder to shop. If you go with another lender to run your credit and then you call the builder, guess what? The builder's going to run your credit as well. I don't care what anyone says. Oh, you can run your credit as much as you want within 45 days and it counts as one inquiry. Not. Talk to any credit repair person. They will not even want to jack with doing an inquiry on your credit because they don't want to bring it down. No one wants to be the one that brings it down. Trust me. Right? So if your credit's ran, you don't want it ran by like a bunch of people within 45 days. Just take that credit score and talk to a few other lenders. All right? Hopefully that helps you out. Can I gift my daughter $20K without paying taxes? I'm in California. So, and underwritten by your people, by my people. So, if you are gifting the money, no one's going to wax you, Lisa. It's your daughter. I think it's over 15 grand. They're going to wax her 5 grand if she claims it as a gift. All right? It's up to her. Not telling you what to do or what not do or what not to do. If you gift 20 grand, no one's asking you any question. They're going to wax your daughter on that $5,000, which is not bad. All right? It's on hit on ordinary taxes. Alan, hi. We just established an LLC for our rentals. We are planning to buy an owner occupied next year. Will lenders consider LLC even if it's less than 2 years? I have a W-2 income too. So they're gonna look at all your rental properties. They're gonna go off the tax returns. If doesn't matter if they're in different LLCs or it's been, they're going to look at the history on what the rent is being collected on the rental properties. All right. If it's in the LLC, they're going to want to see the breakdown for the rentals. Hopefully that helps you out. Anthony, you're all over the map, man. Stay in your lane. Thanks, Anthony. Lucy. They recommend. Thank you so much, Quentin. Jasmine. So the same with Bitcoin. Yes. The same. That's the golden about crypto. That's right. See, all these people on crypto here, how to get with the times, how to learn about that crypto stuff. Why are interest rates higher for a condo on a conventional loan, putting 5% down? There's something called loan level pricing adjustments, right? Fannie Mae and Freddie Mac consider condos a little bit higher of a risk. Remember, it can be warnable and non-warnable the next day, right? There's a lot higher risk, Robert. Hopefully that helps you out. Different with townhouses. Townhouses and single-family homes are the same. Why are interest rates higher? 5% down, 770 score. So Robert, if it was me, I would go with I would try to talk to another lender, right? Especially right now. Okay, let me tell you a secret here. So sometimes rates are high depending on the lender you're working with, right? So if you go to a lender that might not have high rates, it doesn't matter if it's a condo or not. So I would look at a different lender, right? Typically these big mortgage banks, they have higher rates. Unless you use their, when the ones that they're offering these hotlines that you call in, right? Those are different. So there's something called direct and retail. Retail is like a loan officer works for, I don't want to badmouth a big bank, but big mortgage bank. Let's say it's a bank that when you make a mortgage payment, they collect the payment, right? I call that a big bank, right? And they have a corporate manager, a regional manager, a West Coast, East Coast manager. Typically the rates are higher. So if you go with them and they have a condo adjustment, that makes their rate even higher. maybe go with a small direct lender that doesn't, you know, doesn't service your loan, doesn't have these 5 different managers on top of them. Maybe their rate, even with a loan, the condo adjustment might not be as high because they don't have these huge corporate margins to cover all these people. Or a mortgage broker, same thing, right? So be very careful, especially when you're shopping right now. I don't like the big banks unless you need a spot approval, right? I don't like them if you're not doing a renovation loan. If you're going with a conventional FHA, VA, right? Or non-qualified mortgage, I like the small direct lenders. That's why I joined one, right? And I like the mortgage brokers, which I send a lot of business to, right? But if you're looking for a USDA, a renovation loan, a down payment assistance loan, right? I like the loan depots, the guarantee rate, the movements, the new American fundings, right? But of course, for refinances, sometimes they have their own little department. They have cheap, lower rates, right? If the loan officer works, depending on the department they work for, it has different rates. If you want more details on that, Robert, do reach out to me. If you want help to see if you can help read or shop your loan, give us a call, 714-790-9697, or you can always message us, all right? All right, let me see here, reply to Lucy. I don't think I skipped her question. Lucy asked that question again if I skipped. Any ideas on how to finance an ADU after buying an FHA or conventional loan? Yes, you can do a renovation loan and finance it, all right? Everything pie. We just haven't gotten this far down the comment yet. We'll get to it. Okay. Is it a bad time right now to buy, as I have hearing that the market's going to crash? Yanette, who told you the market's going to crash? There's one guy still pushing it. First of all, he's not an American. He is a foreigner, right? he's a Canadian. He's reading reports. He's not in the industry. Right now, Yanette, why don't you go out and write an offer? See how fast it takes to get your offer accepted, right? You're going to be waiting. I don't see it right now. We're short 6.8 million homes in the United States. Yes, people aren't overpaying for properties. They're paying fair market value. But there are a handful of people that did, right, put the homes on the market, overpriced them because they thought the market was still that hot. It's still hot, so try to write an offer, right? If you're in a metropolitan area, it ain't that easy to get your offer accepted. There's just not enough properties. So whoever's telling you this, the home must be in Edmond, Oklahoma, or Imperial. I also throw that in there, Andy. Edmond, Oklahoma, or Imperial County, California, right? Or Butler, California. All right. Let me see here. Yanette, that's what I've heard. I'm so scared because it's so high. How would you profit in the future? If you buy anything you hold long term, prices do crack, it'll bounce back. But Lucy, the longer you wait, Yanette, you're gonna overpay. This is what you know that. So a loan amount of $700,000. Think of it, guys. Use your mortgage calculator. A loan amount of $700,000 when rates are at 3%, the payment's cheaper than the loan amount at $550 and rates are at 5%. By only $1, but you can see the difference, right? Let's say prices do drop, Lucy and Yanette, and you don't buy. How you gonna tell me you're gonna buy? You're telling me you're gonna compete with Invesco, JP Morgan, and Blackstone, and these other iBuys that are gonna pay cash for property. So let's say if home dips, let's say a $700,000 home turns to $600,000. You don't think every investor is going to come out of the woodwork? You don't think all the Chinese, all the Germans, Australians are going to come out and pay cash for those properties? And these hedge funds that are coming to our country and are able to pay cash for it? Right now, the prime of the market, 1 out of every 4 properties are bought by an investor. So if you're sitting there waiting for the market to turn because you're going to get some deal, it's not going to happen. I'm not being mean, I'm being straightforward, because everyone who's using fear-mongering to scare people not to buy, they're just pushing you further away from buying a home. And they will lock in that payment. Most likely, Lucy and Yanette, if you were able to afford to buy last year, ask yourself this: can you still buy that same home this year that you were able to buy last year? Most likely not. For me, I sure couldn't, right? $780, now it's $941. I probably could, but it would stretch I would be pushing it, right? So definitely, guys, if you're trying to think that some price is going to drop and you're going to get some deal, it's not going to happen, right? It's not going to happen. How would it happen? Tell me this, okay? There's only 1.1 million homes left in mortgage forbearance. We're short 6.8 million homes in the United States right now, right? If it was happening, builders would not be building homes right now, right? They just can't get the material to build. So there's not building enough property. Also, next year, you got loan on limits going up, right? Bringing more buyers who probably couldn't afford a bigger down payment to buy homes, right? The Helpers Act is going to be released. One of Biden's home buyer programs are going to come out, right? The $15,000 tax credit or the $25,000 grant. You're going to flood the market with more buyers. How would that happen? I just don't see it. I'm not telling you this to be mean. I'm telling you this to give you reality. Is like, it's not going to happen. If it does, the people who are going to benefit are the people you probably not going to be most of us, right? They just printed almost 40% of our currency in the United States in the last 12 months. You know where all that money went? It didn't stay here with all low income, middle income. It all went to upper class, right? It went to the rich. So when you do all that money, they're going to keep buying up the United States, turning our country into a landlord, a rental country, right? So if you do qualify, lock in something. If you don't, I don't know where you're going to be, all right? Hopefully that helps you out. If the market was to crash, how would you even qualify for buying a home, right? So if the market crashes, right? If you, Lucy or Yannette, unless you have some crazy government job, if the market crashes, I will lose my job. Probably most people will lose their job too. They probably couldn't afford the home in the first place. All right. Rates are going to go up next year, Lucy. Gus, what's gift of equity? Gift of equity is when someone lives in the house. Let's say I live in a house and it's worth $500,000 and I owe $300,000 on it. I have $200,000 in equity. Let's say you want to buy that house from me. You're my relative. I can gift you my $200,000 equity, right? So you can use that $200,000 to cover the down payment or closing costs, or gift you whatever out of that $200,000. Hopefully that helps you out. That's a gift because there's no money. It's just the equity I have. I'm gifting to you to cover your down payment and closing costs. Jolene, what's going on? Robert, what's going on? Gus, I was recently added to my parents' loan because they needed to refi. Now I want to buy a home but cannot qualify because I'm on 2 loans that my parents refi. Yes, they would have to show that they made payments for 12 months on both properties first. Then you can omit it. Then you can qualify to buy. Is it normal for some brokers to charge you with DOE title and escrow fees when refinancing? Most likely the broker's not charging you. It's title and escrow. All right. I'm 99% sure it's not the broker. Guys, when you do get a loan, there's title fees, which those are your fees, escrow fees, lender fees, miscellaneous, and impounds. The broker or the bank can control lender fees and some miscellaneous. They can't control title, they can't control escrow, and they can't control your impounds. All right? Hopefully that helps you out. How much more than asking price would you go over? Right now, I would probably go like 5 to 10% max. All right? What up, Mauricio? Buy and get the lowest rate possible, FHA or other program if necessary, then refinance to fix it. Yes. People won't be buying or selling like before. I completely agree, Mauricio. Yannette, thank you so much. Right? Lucy, thank you. Mauricio, everyone who reached out to me, thank you guys so much. Jolene, Gus, Robert, everyone else who reached out, thank you for everyone who asked a question. Thank you so much. I've worked so hard to raise my credit and owe nothing. I've learned so much. Thank you so much. Guys, hopefully I brought you value. Guys, if you haven't yet, definitely help me out. Save this video, share this video, and like it. And follow me on YouTube and TikTok. We need the subs. All right, guys? And we want to end all our episodes with our attitude is gratitude. If you need, without you, there would be no us. So thank you guys so much.